All right, so since we've already looked at the diversification and you guys already know what you want to look for depending on your goal, you already know like which one you want to aim for and like, okay, that one's the best one. I want to show you a video. To me, he's the best investor when it comes to diversification because he has such a long track record and he has a great approach when it comes to diversification. His name is Ray Dalio. I recommend to read a few of his books. I've read several of his books and they're really good. Like it's been like a bit more than a year now. I read his book, The World Changing Order, and it was a great, phenomenal book. It gave me a lot of insight too. Ray Dalio is a really great investor. I mean, and I like him personally into the way how he thinks about things and the way how he thinks about people. I think he's a great person too. That's just my personal thing. That's my stuff now. But as an investor, he's a great way to learn from. He invests in a way like he invests like in 500 different things, 500 different assets, right? And I'm perfectly fine with that. It works for him, right? His net worth is now like $30 billion. So yeah, he definitely is a person that you can learn from because he's gotten these results. Like he was able to build his hedge fund so valuable in just 40 years or so, like 40 years, that he made it just a few $1,000,000 to now. Look, it started in 1975. When did Ray Dalio? I really recommend you to look at his story and study him. Right? There's many. I'll dedicate a lesson because I think it's so valuable. Because I've learned a lot from these people. And I've constructed my own way. But I think it's also really good for you guys to learn from them directly too, because they also give invaluable advice to what you're doing, especially in investing. So I wanted to search up when did Ray Dalio almost go bankrupt, because he didn't. Okay, that was in 1982. Yeah, you'll see his story. I'm not going to explain his story here, but I want you to like search up his story. Yeah, he almost went broke in 1982, but it was because he invested in a different way in 80s compared to now, very different, and he was a very different person. He actually had a high ego. He was a very braggy person, very different person from now. Now he's pretty humble. He's a pretty humble person now. He's really nice. He's really friendly. But he became humble. Like the humble lesson was when he went broke and he realized that, you don't make money by betting, by making a huge bet, but you make your money hugely. Like he realized a lot of this sort of way of investing by diversification and allocating in great investments and a more steady return when he actually started meditating. He started meditating when he went broke, because that was, when you go broke and after this you start to become more spiritual and realize something from yourself. It's definitely a person you can learn a lot from, because he has a lot. I mean, he started the stock market when he was, he began investing at age 12. He began a little bit earlier than me, but yeah, he's definitely a person to learn from, because I want to know what year, like when he started to make like those sort of consistent returns. Bridgewater is just it's actually the largest hedge fund in the world, right? And I'm glad it is, because it's actually the best, in my opinion. It's the best hedge fund in the world because it's operated. Now it's not anymore, but the system of the way Ray Dalio left it as, from algorithms, because no one, yeah, you will see. I will leave it at that. I will let him explain to you. Yeah, he has a philosophy based on notion that cause and effect relationships. I also believe in the same way. He believes a lot in cause and effects, and they're the key to understanding complex realities. Dalio believes that studying how these relationships have shaped the past provides the key to making optimal decisions in the present and unlocking success in the future. Yeah, and the great thing that I like about his hedge fund is that he operates in a way that he believes so much in principles. He believes in principle focused on cause and effect relationships and depth analysis of past phenomena. He has a philosophy and culture of idea meritocracy, so in radical transparency, have been influential in the financial world and beyond. That's a great thing about his culture in Bridgewater, that he builds his company based on meritocracy. So what that means is that a bunch of like-minded people, but people who are masters in their own field, from all fields, and he gets them into a table, like really like a mastermind group, and he transfers different values with each other through radical transparency. And he tries to know, I know so much, but let me get your end of what you know, and let me get the other person's end. And they all try to get into these sort of agreement to conclusion in what they know overall. And no one even chooses, right? That's the great thing about it. No one chooses what the decision is. Overall, a machine does, based on probabilities, and the machine is more accurate than the human. So you can see it's very advanced what he did, and he left it like that. I'm not recommending. I'm not a financial advisor, but he just has the longest track record. But Bridgewater really blew up though. Like it was really well known to what it is today because of what he did in 2009. He didn't predict, like no one predicts the stock market, but he knew that something big was going to happen in 2008, because there was all this sort of irrational behavior with subprime mortgages, and that he knew that it was in a bubble and the bubble will burst eventually. And he did, and he made a lot of money out of the 2008. So yeah, just definitely a person to learn. I would look when it comes to the market, you want to learn from as many people as you can. And I have a portfolio of a bunch of I have a playlist of a bunch of investors that I've learned from, and I'm pretty open, right? I'd recommend you to learn from many different of them because they're definitely going to make you a better investor from learning from their mistakes, their perspective, right? There's nothing better than to get perspective rather than just one person, right? Because I can give you the most perspective as I can because I learn from these people. But there's nothing better than to get for more perspective, right? But actually from people that know. Don't get perspective from a whole bunch of people who don't know as much. Like don't get perspective about all time investing and what you should do or don't do based on your parents if they've never really invested. You see what I mean? Like invest in people who do know. All right, so let me start this video. He's going to explain about diversification and how he goes about it. It's a very short video. It's like 5 minutes. And it's similar to what we've been talking about, but this is the king of diversification.
The real question for me was, what were the marginal benefits of diversification like? How what is that going to look like? Okay. And what I then decided to do was to think about risk and the number of sample size and the correlation of the bets, broke it down to each of its components, right? So, to use an example, let's assume you have, to make it simple, a return, something that has a 10% risk. We'll call risk standard deviation. And let's make it simple, and let's say it had a 10% return. And let's say I add in another asset, another return asset, return stream. I add in a second, a third, a fourth, a fifth, up to whatever number. How would that reduce my risk if it on average has a 60% correlation? Or if it has on average has a 40% correlation or a 0% correlation? How would that change? Wanted to know that, right? So that's what this chart shows, right? And so, so imagine you have a 10% average return. You don't know which bet is going to be better. Has a 10% average return and a 10% risk, and you add in a second and a third and so on. You're not going to lose the 10% because you're still going to have that 10% return, but you're going to then have a reduction, and that's the reduction in risk. And if it has a 60% correlation and you have 3 or 4, you will get a reduction that maybe is about 15%. And you could add in 1,000 if they're 60% correlated, and you're not going to reduce your risk much. Okay, that's important. Now, if I look at that, how that changes according to the levels of the correlation, I start to think, well, what would happen if I added in something that had a 10% correlation, by way of example? Okay, now that's what that line shows, okay? And it shows how much, okay, at about 7 or 8 or so, I cut my risk in half. That means I've doubled my return relative to my risk, right? Ooh, that's good. So as I go down this, I then start to understand what the power of diversification is in terms of the things that I'm going to look for. So what that taught me is the magic is you only need to do this simple thing. The simple thing is to find 15 or 20 good, uncorrelated return streams. Things that are probably going to make money, but you don't know, but they have a good probability of making money. And that are uncorrelated, that have low correlation. That told me that's what I have to go after, right? That's the key. A lot of people think that the most important thing you could do is find the best investments. Okay? That's important, okay? But there is no great one best investment that can compete with something like this. So look at this line. When this comes down, you can improve your return to risk ratio by a factor of 5, right? 5 times the expected return for that unit of risk. You can't pick any investments that are probably, nobody's humanly capable in an efficient market probably to pick investments that are 5 times as good individually, but so that path. So it tells me about the power of diversification and balancing risk. So this is the return to risk ratio that happens for each one of those. You know, like if I can get zero correlation and I have 15 to 20, I'll have an information ratio, a return to risk ratio of 1.25. That means my probability of losing money in a year is only 11%, okay? As distinct from 40% with any one of us. So that's the power of portfolio construction and the power of diversification, okay? So it tells me what I have to go after.
Right. So, yeah, he basically explained kind of the same thing what I told you guys. He just explained it in a bit more detailed way of showing you by risk and return. But it's really the same thing of what I've been talking about. He just explained, so you guys can understand. When he talks about correlation, he's referring to the relatability towards the business. So let me give you an example. If you invest in, let's say 50%, which I know you're not going to do, but let's say like 40% or 30% of your portfolio has financials. Right? It has banks. It has Bank of America, JP Morgan, Citigroup, Capital One, Visa, MasterCard, American Express. These aren't businesses that you should invest in. I'm just giving you examples. US Bank Corp, right? Those about, I think I said like 7 companies, 8 companies, 9 companies. And let's say if they're 30% of your portfolio, right? If you invest 30%, which is about almost a predictable category of what I'm telling you, that's way too much risk. And that's what he refers to. That if I go back to here, right? When he's talking about, I just want to find the area where he's when he talks about, for example, when he says a 10% correlation, that refers to the amount of similarity on the business compared to the other business, right? So this would mean like if you invest, let's say that you decided to invest in, let's say Microsoft, which is a technology company, but then you decided to invest in, let's say United Healthcare. Both of them have no correlation whatsoever because Microsoft sells completely different products and they're in a completely different sector and industry. And United Healthcare is also in a completely different products, different services, in a completely different industry. United Healthcare sells, they give life insurance. Rather, Microsoft sells Windows operating systems, cloud-based systems, cloud provider, zero correlation. By this nature, the more assets you have in zero correlation, the lower the risk you will have based upon, now when he talks about risk, I just want you to let you know that he's talking about risk per year. That's all it means. Risk per year, that's really all it means. And this increases the amount of your return because it really refers to the amount of all the investments that you're going to make are great investments. But if they have a 0% correlation, that's even better because if one of them is going down temporarily, right, but the other is going up, your total return will be positive because there's 0% correlation. Whether one is going up completely, the other one can be going down. But in total, you can see that if you have 5 companies, right, this will higher risk, obviously, because you don't have much of the just allocation per instrument, right? But you see, if you get up to 10, right, like 10 different companies, that's when your risk starts to go down a lot. When you go up to 15, that's when your risk starts to really go down. Like when you go up to 19 to 20, your risk goes down. And let's say that these 20 companies were all in this portfolio, right? So what that would mean is that so this in total, I think is like 58%. So 20, what's 58% of 20? So it'd be about 11 companies. So you would have 11 companies here, 8% of 20, which is about 1 company, right? 1 company or maybe 2. This would be about 1 company. This would be about 2 companies. This would be about, again, 2 companies. And this would be about, the S&P 500. So now in total, you have almost 12 here, right? You have 11, you have 12 here, 12 here. You have 1 or 2. So you have 14, 15, you have 16, 17, 18, 19, 20. You see? 20. So that's what I mean. But if all of them are uncorrelated, right? The more uncorrelated they are, now it doesn't mean, when he's talking about uncorrelation, it doesn't mean that you have to seek for 0% correlation per business. No, not at all. It just means that if you're able to make a little bit more than 60 to 70% of your portfolio of assets in businesses that have up to 20 to 0% correlation with each other, ideally 0% correlation, the lower your risk will be and the better your return. The lower your risk because you have already 20 companies or more companies, and because there's 0% correlation, if those companies and each of the companies are going down, which are going to go down most of all from an industry for sector, that other company will be going up from a different sector because it's doing well from the sector, right? So from this nature, he's already telling you by really having a 0% correlation, the probability of losing money in 1 year temporarily is 11%. It's a very low percentage. And you're already making about 500% compared to your risk. Because if you're risking about 3%, right? Because you're already losing about 3%, but from here, you'll be gaining about 125% from just a 0% correlation. Because if one is going down, if a few of a very small portion of your portfolio is going down because of its sector, but that's just the sector and the rest are going up, you should have somewhat around that. Now, it doesn't mean that you're going to have guaranteed that if you're losing 3% on one area, that in total that and they're improving and that you're going to have 125%. No, that's not what I'm just saying. That he's just giving that as an example, but he's giving this as a statistical sort of probability that you can get based on the amount of assets you're owning, the amount of allocation that you have in, the amount of correlation between each businesses, and just the overall very, let's say, estimation of what your risk to return will be based upon how much correlation you have between businesses. And from that, it will show you the probabilities of losing money in a given year. But to me, this isn't a big problem when you talk about probability, because this is just portfolio performance per year. The way how he invests, he doesn't have all assets into the stock market. He has all assets. Like, he has virtually all the assets you can ever think of. He has gold, bonds, notes, treasury securities, mutual funds in ways, stocks, silver, real estate, particular real estate, mining, oil, like all the kind of things that you can ever think of. Government debt, like all the other type of things you can think of. He has like 500 of these different assets, right? So that's why to him it's important to do this, right? And he's able to get this because there's really no correlation with asset. Now, this refers to the asset, right? This refers to the asset as well. This refers to like if you're trying to do that. But keep in mind that Ray Dalio, the way how he invests, to me, I would say if you're looking to leave an inheritance for your great-great-grandchildren, I would say you want to do what he's doing. You want to invest in many different assets, not just invest in stocks. Why? Because certain companies will not survive in 300 years. That's just not, like, that's not realistic. I don't think that will happen because it's not, nothing can last that long, at least for a company, because of new innovation. And sometimes you can't keep a company, or at least I don't know. It's beyond my knowledge of knowing. So in order to fill that unknowing for 300 years, if you're looking to make a return in 300 years, a solid return, do exactly what he's doing with investing in different assets, with a whole variety of different assets, right? To me, I don't invest this way because that's not my goal. I don't really care about that. I just care about getting a very sure return in a quicker time. And I don't see his type of investing as necessary, but I definitely learn from what he knows. Okay, so that's kind of the approach, right? So I kind of wanted to explain the way how he does things. He calls that the holy grail of investing as diversification that you can get. But this rule applies with stocks in terms of businesses, in terms of sectors or industries. All right. If you invest the way how he does, you're going to get a much lower return, a very, very much more lower return. Right. And that's why I don't invest the way how he does, but it's because it's for the long term. Remember, that's kind of the way how the investing works. The more longer you're going to hold an asset for so long, the slower the return will be in the short term, in like years to come by, in 20 years or so, or 30 years. But the return will show to fruition in 100 to 90 to more than you're dead, right? Because that's what he does. Now, I'm not going to say he still has a really great record, of course, of bringing his net worth up so much in the past 40 years. But I think that was more because of his hedge fund. That's similar to what happened to Warren Buffett. He was able to comprise his hedge fund so well that he attracted many people, and where he earned a lot from that, and he was able to invest more into the markets individually or into that. He does make a stable return for people. Again, it depends. Whether you want to leave an inheritance, do what he's doing. If you just want a great return with wealth generation, you don't have to do that. But I would follow his advice and learn from him because he's the king of diversification. And I would say learn from what he talks about, what I just showed you when it comes to risk correlation, and that the lower your correlation is, the more return you will have per year on a sector. Now, just keep in mind that it won't mean that the more return that you will have. No, not at all. It just means that what he showed was like how to basically get almost always a positive performance every year if the markets are really going down, because you have 0% correlation. It's pretty obvious. But you won't make a higher return, right? It doesn't mean that you're going to make a higher return in the long term with this. because the only way how to make a high return in the long term is by investing individually in a business. If it's a really good business, and you are investing in individual business, but just keep in mind, you have to understand that the more investments you make in all, the lower your return will be, because you're not allocating as much. That's why I say, like, look, if you just want diversification, you don't have to do what he does. I'd rather just do that in the S&P 500 because it already comprises 500 of the biggest companies. When it comes to the markets, when it comes to leaving an inheritance, like what he's doing, you want to get multiple different assets, like what he's doing. But I don't think that's necessary. And so, yeah, he has a long track record. He's had a consistent return. He hasn't had always a consistent return every year. He's had negative returns for his firm when the markets have come down, but nonetheless, he's had an average return of about, I think Bridgewater's had an average return of 18 to 20%. So it's actually pretty good. You will make a pretty good return in the long term. You're not going to make such a high return if you do that with what he does. And you're not going to make as much of a high return either if you have more than, I don't know, 50 companies. I would recommend for everyone, look, I would say if you're looking for consistent return every year, right? If you're looking for your portfolio to be positive and as much minimal drawdowns as you can, I would recommend you to invest no more than 30 companies. So I'd recommend you to invest up to 25, like 20 to 30 companies. If you're fine though, with a little fluctuations a bit, and you want to make a bigger return compared to that first diversification, if you want to make a little bit of a bigger return and don't mind a little bit of the volatility in the short term and where your portfolio can go down, you're negative, but you can buy more businesses actually, and you can allocate a little bit more, which will increase your return to the better businesses, then you can comprise your portfolio up to 15 to 20 companies like that. Now, if you really do not mind volatility at all, right? If you're just focused in the long term for 10 to 20 years, which is the whole point of investing. I don't invest for 5 years. I actually invest all my different investments no little than 11 to 12 years. Every time I invest in a company, I always invest like this company's going to make more money at least in more than 10 years and at least more than 15 years. Usually I would say in average, all the companies I invest in have an expectancy of making more money in more than 20 to 30 years. I never look at that at the short term. So I would say if you have the same mindset as me, if you don't care if your portfolio goes down to even all the way as much as it wants to, because you know how solid the business are and you're just investing in the business. You're not investing in a stock, but you're investing in the business and the pure business of what it's doing. When you buy the stock, you're buying the business. You're not buying the stock when the stock goes down. You're buying the business cheaper. You're not losing in the stock. You're just buying the business cheaper. If you have this mindset really up to the core, because I know a lot of people aren't, even though I'm explaining it as it is the business, but I know some people are not going to get it fully through. So I just want to eliminate their folly on that end by diversifying. But if you have this mindset, but you still don't want to at least lose as much, if you still want to have a little bit of stability in your account per year, but you don't mind the volatility, I would recommend you don't have to invest like 15. You don't have to invest like 15. You can invest up to even 10 to 12 companies in total, right? 10 to 12 companies. But these 10 to 12 companies have to be the best companies in the world. What I mean by that is that if you get 20 companies, right? Then you look at, okay, what are the best out of the 20? Then it's 15. Okay, what are the businesses that I absolutely understand, that make absolutely sense to me from what they do and all? And I know for sure that they have better products, better services to the most that I understand fully. And so that I know what are the risks, the possible risk, and that I won't even touch that risk, that it will do better on later on. That you really understand the products and services. Okay, out of those 15 companies, I really understand 10 of those companies. Okay, then those 10 companies, those are the companies that you invest in, because they're really by nature the best companies you can ever invest in, because you really grab all the best, and in the best you grab the best in the best, and in the best you grab the ones that you understand completely in value, and by that nature they're the best investments that you can ever have. Those are the different categories. There's about 3 different ways. That's the way how you can do it. Remember, you need to keep in mind that you're not investing in a stock, you're investing in a business, right? Because he talks about the probability of losing money in a given year, since he says there is no best investment and you could be wrong. And that's perfectly fine. But the thing is, right, because you have to understand the perspective, right? Ray Dalio invests in 500 assets, 500 different assets. That's vital for him to know that for what he does, because he, by that nature, invests in 500 different things. If you're investing in 500 different things, 500 things are not really good things, right? There's not going to be really good products, really good services that are 500, right? That's very rare. So that's why it's vital for him to have those rules, because by nature, and excuse my language, if you're investing in 500 different things, you're going to sometimes pick a few shitty companies, right? Or you're going to pick out a few shitty assets because there's no way that there's spectacular assets of 500 amounts, or else a lot of people would be very rich, but that's not the case. So that's why it's vital. But for us, right, this would be necessary if you're investing in stocks, right? And this is what majority of everyone does, in which they look at the risk of losing money. But you need to remember that the only time that you're going to lose money in the stock market is when you sell, a company. And first of all, this isn't even the case for us because we're not buying stock, we're buying a business. When you invest in any business from now on in the stock market, you're not going to think of the scenarios of losing money. Why? Because you did that earlier. When you're analyzing a company, you already fact checked so many criterias that it's even beyond the scale of losing money, right? Of course, everything has inherent risk, right? That's the whole nature of investing. That's kind of like how humans have like death, right? It's inevitable, but you reduce dramatically those chances of losing money if you're just very logical and only choosing the best companies that you can ever see, in which by that nature are not going to be a lot of companies. Why? Because you can't understand everything. There's no way, it's absolutely not humanly possible that a person can invest in a company, many different companies, and they can all do well. Why? Because many different things don't work out well. So you have to select very few amount of things. Now, if you select a few amount of things, you're going to have the probability of losing money almost to zero. So that's why I don't look much at that sort of scale when he talks about probability of losing money, neither the return to risk, because the risk there is already mitigated with the analysis of what we're doing, right? This is very crucial because this is such a complicated topic that many people like to mess with, and there's a lot of ignorance with it because people don't understand it fully. And this is a subject that we're going to really talk down and deeply in the next few lessons, because it's important to understand the distinction between when you're diversifying and when you're consolidating, and you have to know the reasons why you're doing that. And keep in mind that we don't care about the returns that we do in a year or 3 years or 4 years. We're looking to hold these companies because we see that they can make 5 times, 10 times their money in the next 20 to 30 to 40 years, right? That's the goal that we're keeping on. We don't care how we're performing in the next few years. Remember what I said earlier? I said that you don't want to make your portfolio look pretty. You want to make it pretty. You want to make it good. The way how to make it good is by choosing logical businesses you understand, right? And not to create a big mess of amount of businesses just for the sake of diversifying. I never want you to do that. A lot of people have that misconception, but that's why they don't do well, because it's so logical. It's so simple, because not a lot of things work, right? So why would you choose many different companies just because of the sake that you need to diversify? That's nonsense. It's actually a very common thing in Wall Street, but that's complete false leading, because look at what I said. It's common sense. A lot of things don't work. You have to choose the very few things that do work. Okay, so that's why when you think of probability of losing money in a given year, that's not much of an inherent risk, because you're choosing a big business, right? Now, in the whole, because you might be saying like, okay, then what about diversification? Well, look, I don't want to talk about it now because I want you guys to understand the diversification, but diversification is a very great way to start in investing, because it creates a solid and stable return for a beginner and, let's say, an intermediate to go into investing, because I know automatically anyone who's going to start to invest are not going to choose maybe the best investment immediately, because they don't understand what makes up a great qualities in a business immediately. And that's completely normal, right? Because that stuff is done by experience and knowledge. And that's what happened to me. But that's why diversification is a best route for those. But when you become more advanced, you don't have to diversify as much, because you understand a lot with investing. Okay, so I just want to let you know on that. Don't be a bit confused when he talks about probability of losing money, because recall that that's for stocks. That's stock picking. We're not doing that. We're picking businesses. You have to really look at probability of losing money if you're going to be holding companies for 2 years, and that's the case of a stock. But we're not doing any of those nonsense sort of trickery. We're holding businesses for the next 30 to 40 years. By that, we're going to hold very, very close and selective businesses that we chose out with a huge amount of challenges, okay? All right, so that's it for this video. I will see you guys in the next video.